The board of 197 Communications Limited, the parent of digital payments provider Paytm, has approved a share buyback proposal. The decision comes less than 13 months after Paytm's disastrous listing. Against this backdrop, how will the buyback affect the company's fortunes and investors? And what are the concerns surrounding the decision? Bashwar Kumar brings you the answers.
In an apparent bid to arrest the fall in its stock price and instill some confidence in investors, the board of 197 Communications on Tuesday announced a 850 crore rupee share buyback by Paytm through the open market route. It comes within 13 months of the loss-making digital payments majors listing. The shares of Paytm have tanked about 75% from the IPO price. Under the buyback scheme, a company purchases its shares from investors and shareholders by offering them a better price from the current stock price. It is seen as a tax-efficient alternative for returning money to shareholders. The maximum size of the Paytm buyback is 850 crore rupees, excluding the buyback tax. Paytm said that the maximum buyback size was less than 10% of the company's total paid-up share capital and free reserves combined, as on March 31st, 2022. In India, a buyback's maximum limit is 25% of the company's aggregate paid-up capital and free reserves. The 197 Communications Board approved the buyback at 810 rupees per share, which amounts to a discount of over 60% on the IPO price. However, it is also a 50% premium to Tuesday's closing price. Since its primary market debut, the Paytm stock has witnessed a sharp decline. Its IPO was India's largest back then. The company had raised 8,300 crore rupees by issuing fresh shares at 2,150 rupees apiece. The issue also comprised a secondary share sale worth 10,000 crore rupees. On the bourses, shares of the fintech company fell 3% to 525.60 rupees in Wednesday's intraday trade, before closing at 529 rupees apiece on the BSE. In recent weeks, analysts had turned more positive about Paytm's stock. According to Bloomberg, in what was the highest such number since its trading debut, 8 of the 12 analysts tracking the stock were recommending a buy or equivalent rating. In a note to clients, analysts at global brokerage JP Morgan wrote that they expected the buyback to provide support to the stock price in the near term. We reached out to market analysts to find out how the buyback would impact investors and the stock. Paytm reported a widening of its consolidated loss to slightly over 570 crore rupees for the September quarter. However, its net loss narrowed on a sequential basis. According to a company statement, the Paytm board believes that the buyback is a sign of confidence that the company is on a clear path to deliver cash flow profitability. The board also believes that the buyback will not have any impact on Paytm's plans to become profitable and for growth in the near future. Usually, companies consider EBITDA while looking at profitability, but in Paytm's case, the fintech firm is looking at an EBITDA plus calculation, factoring in ESOP costs. Paytm says it is ahead of its plans to achieve profitability on this basis by the quarter ending September 2023. But the buyback has drawn skepticism with regard to Paytm's growth prospects, and not everyone is so sanguine about the company's future.
As per the last two quarterly results, if one has to annualize, this year could well be about 2,500 crore worth of loss as far as I think the business operations of the company is concerned. We do not see the revenue model and the profit-making model. I think the money which was collected for building the business is now being paid off to investors who invested into it. This could possibly be starting of, I think, a significant amount of fall for the business of Paytm per se going forward. So one will have to wait and see how exactly they manage to arrest losses and how they manage to survive in a situation when they are depleting cash from the balance sheet.